Hello, it's only you and me.
How's it going, man?
Great, buddy.
Where are you based?
Delhi only.
Delhi. Where in Delhi?
Gurgaon, वैसे तो I stay in Gurgaon these days.
Okay. And what do you do?
Here I'm into footwear trading.
Okay. So, manufacturer या retail?
Trader.
तो wholesale.
Wholesale.
Got it.
आज कैब चली गई आपकी?
हाँ जी.
टोपी.
टोपी आज है ना, घर से ले रहा हूँ तो घर में ज्यादा.
Last time भी तो you were at home only.
नहीं, last time I was in the office.
You were in the office?
There's a green screen at the back, right? If the green screen is at the back.
अच्छा नहीं, मैंने नहीं ध्यान करा था green screen थी.
Maybe I'm here. Maybe I was here. I don't remember.
एजेंट के तौर पर आपको पूछूं, आपको क्या फर्क देखा? सर पहले क्या था जब हम
अपने आपको.
ये कौन आ गया?
Just give me a sec. Get
No
some.
problem, buddy.
Chalo, what I'll do, I'll get started. And
Good evening.
hi, Om. How are you? So I'll just get started. Sorry, my voice is a little off. As you can probably tell, I have been nursing a sore throat, which does not seem to be going away. So, mute. Today's lesson. So last time we had talked about realized volatility, right? We had calculated, I had shown you guys how to calculate realized volatility on Excel. And I had urged everybody to, download some Nifty data, Nifty ki close prices, download the close prices and calculate the realized volatility yourself. We also know now that when you're trading options, your PNL is in the long run, your PNL is actually driven by the difference between implied volatility and realized volatility. Everything else becomes a secondary factor in the long run. So these are our two magic numbers. Every time we put some trades on, or every time if you're trading using volatility, if you're volatility trading, right? And that's how most professional option traders trade. Professional option traders don't really look at, option charts, underlying charts. There's nobody at Goldman Sachs or Jane Street that has trading view open. So nobody's really looking at charts over there. The big focus is on IV and RV. IV gives me an idea of there's a one-to-one translation between the price of the option today and the implied volatility, right? So now that we know that, our PNL in the long run depends on these two numbers, IV and RV. Today we are going to talk about the relationship between the two. Okay. And historically, what has the relationship been between these two numbers, implied volatility and realized volatility. On average, is are options cheap when looking at it from a realized volatility or implied volatility perspective, or on average are options expensive, right? That is what we want to know. When are options cheap? When are options expensive? Again, from a volatility lens, you have to look at it from a volatility lens. So let me share my screen. Let me open up algo test as well. I'll give you guys a sneak peek to a tool also that we're working on right now. That essentially shows you IV and RV together. I'll show you calculations in Excel first. And I'm going to use NIFTY historical data again today. I have the data until 2023. The tool that I'm going to show you guys today, and we'll probably add it to the production algo test environment maybe in 2 weeks or so that you guys can also have access to it. That will have the full NIFTY data. But abhi ke liye in Excel, I'm going to show you only until 2023. Okay. So I'll also show you some trades that I'm running right now on NIFTY. All of them are sort of doing what I think they're supposed to do. All of them were put in with a volatility lens only. I was only looking at implied volatility. And the good thing was, I was putting these trades on from the perspective of, okay, I needed to make sure that my thesis is sensible because I knew that I had to explain it to you guys. So, and I don't want to look stupid in front of you guys putting these trades on. So there are trades that I put on, last month where I made a lot of mistakes, and I'll share that with you as well. Probably not today, but I'll share that with you next time, because next time is about risk management. The next class is about risk management. Okay. So let's open up. So first of all, I'm going to show you guys this Excel that I worked on, where I had essentially calculated implied volatilities and realized volatilities of NIFTY options going back to 2017. So I have data from 2017 से लेके 2023 तक, and let's look at these together. ठीक है? Share Excel. Share. You guys can see my screen? Cool. Okay, guys. So this is the NIFTY future. I'm only looking at monthly options over here. I'm not looking at weekly options. And what I've done is I've calculated this thing, which is like a 30-day implied volatility. ये मैंने कैसे calculate किया है? Basically normalized implied volatility बोलते हैं इसको. And the reason I'm using normalized implied volatility is because, when an option is expiring in 5 days versus the same option that was expiring, that had an expiry of 28 days, both these options behave very differently. Okay, so the implied volatility of a 5-day option is going to behave very differently from the implied volatility of a 30-day expiry option, or a 22-day option, or even like a 1-year option. Okay, so days to expiry matter. So with that in mind, I wanted to normalize implied volatility. Again, this is a very standard thing to do that most professional option traders do, where they look at normalized volatility, right? So think about it this way, if you guys are looking at, I don't know, man, if you guys look at balance sheets of companies, right? The normalization is essentially, like, think of an accounting ratio, assets, liabilities, net profit margin. Net profit margin is net profit divided by sales. So one company can have 1 rupee of net profit and 5 rupees of sales. The other company can have 2 rupees of net profit, 10 rupees of sales. Net profit margin is going to be the same for both of them, 20%. right? So this is sort of like a normalization way where you can use this, use the same thing across different values to compare, different things to compare. So in my case, I am only looking at IV30 and then I'm calculating RV30, realized volatility over the last 30 days. 30 calendar days is around 21 trading days, right? That's why this is labeled RV21. So these are the two columns I and K that I care about. Okay. And मैं I and M कर रहा हूँ. हाँ. तो आप देखो guys, you guys remember, can someone tell me what is IV? How do I ask this? Okay, I'll just tell it. I'll just say it. So guys, implied volatility, if you guys remember, is forward looking, right? So implied volatility is a prediction essentially. It's the market's prediction that how volatile is the underlying going to be over the next few days, over the life of the option, right? You guys remember that? I remember sharing this on Discord as well. When I had asked you guys to, yes, good. Tanmo, you remember. So implied volatility is forward looking. The IV today tells me the market's consensus expectation of what volatility is going to be over the next few weeks, whatever it is, whatever the expiry of the option is, based on which we got the implied volatility, right? But now realized volatility is something that we were calculating looking at historical data, right? So realized volatility was essentially what I was doing was I was looking at the returns over a certain period, and then I was looking at the prices, I was looking at the daily returns, and then based on that, I was calculating a realized volatility number, right? So this number, for example, was based on these prices. So realized volatility is historical. Okay. So what I've done here is I've essentially shifted my realized volatility up just so that what I want to see is कि जो मेरा implied volatility था. So today my implied volatility says, for example, on 2nd Jan 2017, my IV was 14.21. This was the market's prediction of what the realized volatility will be over the life of the option. Now my option expired on 25th Jan. So roundabout around this date, okay, roundabout around this date, 25th Jan, right here, I will know my realized volatility, right? Hey, what was my actual realized volatility? Market ने predict किया यहाँ पे, let me highlight it. Market ने predict किया यहाँ पे, यार 14.21 होएगा. Actual value क्या निकली? I found the actual value on this date, which was, let's say this guy, 11.1. 11.1 था, 11 point. Just one sec. Just 09. कुछ गड़बड़ है. Zero 06 10.86. Okay. So yeah. So since I'm actually, again, this is normalized volatility, right? So now I understand. So I have my 30-day implied volatility here. My 30-day implied volatility is saying, okay, yaar, what is my implied volatility over the next 30 calendar days? Okay. Today is 2nd Jan 2017. 30 calendar days from now is going to be somewhere around 2nd Feb, right? So this is my prediction for the next 30 days. Okay. Then realized volatility over here on this particular date, somewhere around this period, right? I will know what the realized volatility was. I will now know whether the market's prediction was correct or not, right? So what I've done now is I've essentially shifted. So let's say the market's uh, prediction was 14.21 and the actual value was 11.1. Okay? The actual value was 11.1. So the market over predicted in this case. So what I've done is I've moved this 11.1 over here. You'll see this 11.1 over here. Uska next wala 11.09 you'll see over here. So I've just shifted my realized volatility to align the market's prediction and the actual value that came. Are you guys with me here? Does it make sense? Cool. Tanmoy says yes. If it's confusing, let me know. Okay, na? The whole point of this course is to sort of make it very, very easy for you guys to understand. So, so market ka prediction and actually what happened. इसको hide कर देते हैं. So this difference. Okay, yes, don't worry, I'll explain. So yes, you're with me to understand that the implied volatility is a prediction, right? We all agree the implied volatility is market's prediction as to how volatile the market is going to be in the future, right? We're on the same page there. Now, the realized volatility is, yes, cool. Now, the realized volatility is something that happens over that period, right? So I predict today that something will happen tomorrow. Tomorrow, I will know whether that thing happened or not, right? That is what the realized volatility is. When we calculate realized volatility, we look at the historical price movement of Nifty, and then we get, okay, this is the realized volatility that came out of this price movement, right? On expiry day, that's right. Yahan pe, because it's a little technical, because in this case, what I've done is I'm using normalized implied volatility. Like I said initially, when we started the class, I said that I'm not using the implied volatility of one particular option. I'm using a normalized implied volatility. Think of this as like my own VIX. I've calculated my own VIX. ठीक है, उसमें मैंने क्या रखा है? And the reason I'm using this normalized implied volatility is that an IV with 5 days to go and an IV of an option with 28 days to expiry, these IVs behave very differently. Yeah. So, but in principle, you are right. When you actually put this trade on, right? When you actually put this trade on home, you will care about, hey, what is my realized volatility over the life of the option that I put this trade on? So you're absolutely correct. So imagine karo there's an option that expires in 30 days and उस ऑप्शन की मार्केट में प्राइस आ रही है 14.21 IV. ठीक है, 30 days from now I will know if that 14.21 was too high or too low, right? So I'm predicting something. Prediction is for the future. In the future, I will know whether that prediction was correct or not. This is the prediction. Okay, on 1st Feb, I knew that, okay, this was my prediction, 14.21, and this is what actually happened, 11.1. So I know that the market's prediction was too high, right? Are you with me, AS? Awesome. Awesome. So now all I've done is I've just moved this thing here. I'm like, यार दोनों को same row में ले आता हूँ Excel में ताकि दोनों का difference मैं निकाल सकूँ and I can figure out how good or bad my prediction was. Making sense? ठीक है, cool. So now I've done that for every row. ठीक है ना? Every row I have a prediction, and for every prediction I have the corresponding value के भाई what actually happened in the market, right? So that is what I called RV21 shift 21 कि ये मेरी prediction है, ये हुआ क्या? ये मेरी prediction है, ये हुआ क्या? ये मेरी prediction है, ये हुआ क्या? And notice something interesting, guys. इनका जो difference है वो मैंने यहाँ डाल दिया. which is just essentially I2 minus M2. Okay? Prediction minus what actually happened. This is my I2 minus M2. Okay? So notice something interesting, guys. Okay? Overwhelmingly, the market's prediction is higher than what it actually ends up being. Exactly, yes. IV is higher than RV, right? So something interesting is happening over here. We are seeing that the market is wrong all the time or almost all the time. So then what I did, I calculated this all the way until जहाँ तक मेरे पास data था is Excel में till 1st September 2023. And the tool that I'm going to show you will have all the data, all the Nifty data. So you can see more recently also. In fact, I'll demo it to you guys today only. What happened during election time? There's some interesting stuff there, right? So then what I did, did I plot this somewhere? अरे प्लॉट कहाँ गया मेरा? ये रहा मेरा प्लॉट. Okay. So then what I did, man, my voice. Yeah, sorry about my voice, guys. I have like a sore throat. It just does not seem to go away. So I plotted this volatility risk premium, which is my difference between my prediction and my actual what happened. And what you'll see is that it stays above zero most of the time. You guys remember what happened here? What happened around March 2020, March 2020? What happened around this period? 2020. Yes, COVID. That's right. March 2020. This is where you see this absolute craziness where the risk premium just completely flipped, right? All of a sudden, every option was cheap because the market was going completely crazy, right? Nobody could anticipate what the hell would happen. And this reason is why, people love buying options. Just give me a second. Let me just open my notes. So this COVID chart is the reason people want to be, long. Let me just see. Confused. Sorry. So basically, during this period, realized volatility was insanely high. And if you were short options during this time, you would have taken a loss, right? Every other period, you would have, if you were managing your risk the right way, you would have potentially made money. But this is one period going into COVID, you would have lost a lot of money. Funnily enough, if you would have survived this initial period of selling, right? What you would have seen is that right after the crash happened, the risk premium really exploded. Like the realized volatility was not even close to how high the implied volatility was. So what happened? Implied volatility tends to be higher than realized volatility. This is IV, this is RV. IV tends to be higher than RV. Then all of a sudden something crazy happened and RV just went like this, right? RV just went through the roof. Now, realized volatility will also start increasing and it'll go up again, right? And in this case, options became really expensive after the crash happened. and it stayed expensive for a few months right after that, right? Now, the way to think about this is, so this is where risk management comes in, if you have sold options before COVID, right? You are going to lose money once something crazy happens. Like selling options is sort of like selling insurance, right? Every once in a while, an event will happen where um, the person who has sold the insurance will have to make good the claim. मैंने भाई car insurance बेची, and to the people that I sold car insurance, an abnormally large number of people ended up filing claims. For example, I sold a bunch of health insurance, and then all of a sudden there was some pandemic or something, and now all of a sudden health insurance claims started coming in, right? So there is a risk in selling options. Absolutely, there is a risk in selling options. And the reward for that risk comes through this risk premium. Excuse me. Hot water. So, so this is where the concept of risk management and position sizing specifically comes up, because you know that you're making money. All of a sudden, you lost more than you usually make on average, right? But now that this has happened, now you need to be in a position to take advantage of the dislocation that is happening in the market. So that's why you can't really go like as hard as you would always want to. Like if you look at this chart, right? Let's look at this risk premium chart again. If I'm if I'm in Jan 2020 and I've been selling options since 2017, I've been collecting this premium. I'm very happy. I'm making a lot of money. Maybe I've gotten so overconfident that I've really sized up, right? Sized up ka matlab hai, I have 20 lakhs of capital and I'm selling 10 straddles every day, right? But then something like this happens and it takes away almost all of my P&L. Things would be different, and then I can't play here. Now I've lost so much money. My confidence is shattered. Now I can't play here. This is the time when I should be playing. This is the time when I should be making a lot more than this small amount that I was making, right? So in the case of risk premium extraction strategies like these one, the VRP, you want to size yourself in a way that this kind of a move doesn't destroy you and you still feel confident about playing in this area, right? You still have the capital and the ability to play in this area. So this is empirical. I'm showing you this data. Let me zoom out. This is how the market has behaved in India. But this is a universal truth. It's something that you're going to see anywhere in the world. Every index has this thing called the volatility risk premium. And what you'll see is, what you'll realize is an observation that one of you had actually made, right? Let me share my option chain wala screen. Let's open Nifty only. Let's look at the monthly expiry. So now IV में what you'll see is the risk premium is really high at the bottom, because अगर मेरा realized volatility is let's say 12 or 11 during this period, right? यहाँ पे if it's 12, I'm earning only 1.1 vol point, right? And at the money. But as I go down, I'm earning more in terms of vol points, right? And the reason is people want to pay for these puts. People are more interested in buying downside protection, mutual funds, hedge funds, even PMS folks, right? Uh, FIIs, everybody, like they're all long equity and they're buying niche ki puts along with that, right? So the risk premium is, they want to be insured. The risk premium is higher the further down we go on the put side. यहाँ पे देखो जी 17.7. Notice guys, realized volatility does not depend on the options, right? The realized volatility calculation depends on the underlying. It depends on how Nifty moves, right? So, so essentially, different options have a different risk premium associated with it, depending on the demand supply associated with that particular option. And a general trend is there is more demand for downside puts, which is why the risk premium in downside puts tends to be higher. But ये ₹4 की आप पुट बेच रहे हो, आपको लग रहा है रिस्क प्रीमियम हाई है, बट आपका रिस्क प्रीमियम हाई है, लेकिन उसका ट्रेड ऑफ ये है कि आपका रिस्क रिवॉर्ड बहुत ही ज्यादा स्क्यूड है। ₹112 आप कमा रहे हो। सिनेरियो एनालिसिस में चलते हैं। मार्केट आई गेस इससे ज्यादा लो जा नहीं सकता। कोविड में तो बहुत ही गिर गई थी, 50% गिर गई थी मार्केट, राइट? तो मतलब आपका रिस्क रिवॉर्ड बहुत ही ज्यादा स्क्यूड है। You may be collecting this ball point, but if the market goes crazy, then you will lose a lot of money because of this. So there is a reason why these are expensive. People bid for them, but people who are selling need to be very, very careful. Because when crazy things happen, then you can't really do anything. So I want to, the second part of this, lesson I want to talk about is why this risk premium actually exists. If you guys all joined through the webinar, right? So webinar mein I talked about the two ways in which you can make money in the markets. One is by capturing inefficiencies, and the second is by capturing risk premium, right? So I want to give you guys an intuitive understanding of why this risk premium exists. And the way to do that is sort of, again, it happens through the payoff diagram. So when I buy a call, right? When I buy a call, my maximum loss here is the maximum debit, right? So it's 333 into the lot size, which is showing to me as 8,300 rupees. This is the maximum I'm going to lose. And how much money can I actually make is unlimited, because as the market keeps going up, I'm going to make a lot of money, right? The situation is flipped for option sellers. I'm making a fixed amount of profit if things go my way, but if things go bad, I lose a lot of money, right? So because of this asymmetry of risk, everybody loves to buy options. Everybody wants to make a lot of money in one shot. Everybody wants that lottery ticket, wants to buy that lottery ticket whose numbers actually show up, right? But what is the incentive for the option seller? Like, why would anybody want to sell lottery tickets? And the reason is exactly this, which is the risk premium, right? So there is a reason why these options are expensive. These options are expensive because that risk premium is the compensation that you are receiving for taking on that extra amount of risk. That asymmetry of risk comes from the fact that there is a scenario in the future where you could lose a lot of money, where things could go completely wrong, right? So that is the principle behind risk premium. you are being compensated for taking risk, and your role as an option trader who has a VRP book, like I have a VRP book, I trade VRP along with other things, right? So your role as an option trader who has a VRP book that they are managing. By book, I mean just like, a bunch of trades that are all VRP. So VRP in Bank Nifty, VRP in Nifty, VRP in different indices, where you're trying to exploit the fact that people tend to bid up options. The IVs on average tend to be higher than RV. And you need to make sure that you understand the risk that you're taking and you are able to manage that risk. You want to be the guy who gets hurt on COVID but doesn't get blown out because you want to play the next day when the IV catches up, right? That's where you actually want to play. And that is the philosophy behind risk premia in general, where you who is playing this risk premia game will understand that you are taking a risk. You will accept that, yes, I am taking a risk. I am making money because I am taking a risk. I am not that HFT guy who's going to make money because I have crazy technology that can capture arbitrage moves. No, that is not the case. I will be compensated for taking risk. Somebody else is paying me so that I remove the risk for them, and I am the one who's bearing that risk, right? So selling options is like selling insurance, where somebody does not want to take a risk, and then they say, okay, boss, you take the risk for me, I'll pay you. And you say, I am not going to charge just anything. I'm not going to charge the actuarial fair value. I'm going to charge more than the actuarial fair value. I'm going to charge a premium on top of the fair value because by risk to main le raha hu na, right? And that is the philosophy behind this risk premium. Now, the way to capture this risk premium is, you sell options. But then when you sell options, you need to figure out a way to manage the risk that comes with it, right? So let me show you some trades which I have on right now, on Nifty itself. So this is my eternal option selling trade. I've taken a bunch of trades. I've managed my risk in a bunch of different ways in this particular position. In fact, today only I hedged. It wasn't the best idea to hedge, but the purpose of hedging was um, the purpose of my hedging was you should hedge when you can, not when you must. Like this is a rule it's an old Wall Street rule that hedge when you can, not when you must. Because when it's easy for you to hedge, it costs a little bit of money, but then chalo bhai kar lete hain hedge. By hedge, I mean delta hedge. I flattened my deltas today, right? Because when you're forced to hedge, that's a situation you don't want to be in because the market has moved very much against you. And the reason I hedged this time was because yesterday the market went up quite a bit. And even, let me actually just show you, right? Let's replicate this. Let's replay this. So I put this position on, I started putting this position on. Isko kya ho gaya? One sec, guys. Why is this not showing up on the simulator? Oh, fuck. Okay, this is an interesting one. Nifty has screwed with my lot sizes, right? So that's broken my software. That's really funny. You see these lots, I'm short like minus one third, 0.33 lots. And the reason for that is because of the SEBI lot size change. So 25 quantity now is not possible because the lot size is now 75, right? So if the lot size is 75 and I was short 25, then my software is broken because I didn't anticipate I'm going to make this bug fix. One sec, guys. मेरा payoff diagram ही फट गया basically. That's funny. I should tweet about this. And how do I square this off? That's also another question, right? Because if I want to exit this position, there's no 0.33, there's no 25 contracts available in the market anymore. But anyway, let me just get back to, I'll revisit this point with you guys. Like, this is really funny. So Harshit, next class I'm going to focus on hedging. Okay, how you can actually hedge. Here I'm just थोड़ा मैं ज़्यादा बोल गया because like I was showing you. So typically this is one position that has I've sold a strangle over here and my delta is neutral, and homework for you guys will be yeah, that's different, right? So for you, hedge is buying. For me, hedging is flattening my delta. Excellent point. And we'll talk about this in the next class, where um, hedging is essentially to manage your risk, right? So it's a way to manage your risk. We are engaging in the game of risk premium extraction. So if we are playing the game of risk premium extraction, that means that we are being compensated for taking on risk, and we better know how to manage that risk. Because if we can't manage that risk, then we are going to blow out our capital. So this is one way of putting this trade on, where I put this triangle on. And next class, I'll show you guys, like how I've been managing risk in this particular position. Another way of putting this trade on is by selling time spreads. So here, what I've done is you can sell straddles, etc. as well. You can do all sorts of things. Here, what I've done is I've essentially sold a time spread. So I've sold the Jan options and I bought the Feb options against it, right? This is another way of capturing this. यार असली में my capital is, it runs on algos and like different accounts में चलता है. यहाँ पे I'm putting on the hat of a beginner retail trader, and I'm just trying to really like systematize my thoughts. Hey, every decision I make, I want to make with a volatility lens, and I want to make it so that I can explain it to you guys very, very easily. Right? So, to be able to comfortably trade with large amount of capital, to be able to, to be able to comfortably trade with large amount of capital, you need to first understand your own risk limits and understand whether you actually have edge or not. And before putting on a trade, you should know, okay, hey, this is the trade I'm putting on. These are the things that can happen, that will work for me, that will make money for this trade. And these are the things that will happen that can screw me over, right? So I'm showing you these positions more from the perspective of, I'm showing you these positions more from the perspective of my thought process when I'm putting these trades on, and my thought process when I'm managing the risk, when I'm actually hedging them, right? So these are my two trades that are running right now. Both of them are making money, but there was a time where like this one was losing money for a bit of time. Now it's back to making money. But yeah, so these are two trades that I have on, where I am playing this VRP game. I'm extracting this volatility risk premium. Okay. You can sell straddles, you can sell strangles. Here I've sold like a bunch of different strangles. Sell straddles, sell strangles, sell individual options as well. And there's a reason why some people like selling straddles, some like selling strangles, some will do it with individual options, some will do it with like, another way to do it would be, let me just show you guys another way to do it. Like another way could be, okay, hey, you know what I'm going to do is I'm going to sell a bunch of these, two of these downside puts, and then one of this one, and along with this I'll sell a future. ये बेच दिया मैं, ठीक है. ऐसे भी मेरी volatility risk premium extraction होती है. इसमें आप देखो, मैंने go back to the original formula. I've sold around 13.5, 13.8 vol. If 15 comes, I'm going to be screwed. I'm going to lose money, right? If 12 comes, I'm going to make money. So, the principle here is that you're taking risk. You need to sell these options to capture the edge. And next lesson, I'm going to, show you guys how to manage the risk. The homework for you guys is before you can manage the risk, you need to know how to quantify the risk. Okay, so the homework for you guys is, I just put it over here. Read up on theta, gamma, theta. So I've just posted in Discord. Like these are the parameters that tell me how risky my position is right now. Right. So an interesting point that you made here, Harshit, was for me hedges buy. Right. तुमने बोला कि मैं ऑप्शन बाय करता हूं तो मेरा हेज हो जाता है. So let's clear this out and let's create an iron condor or something like that, right? So iron condor, exactly. चलो भाई, ये बेचा 30 डेल्टा, ये बेचा 30 डेल्टा, और ये मेरा एक फीचर, आई डोंट नो इफ यू सीन दिस, लिमिट योर लॉस. तो इसमें मैं बोलता हूँ फाइंड विंग्स. अबे डबल विंग्स मिल गया इसको, लॉल. तो this is an iron condor, right? So here what you've done is you've sold a strangle and you've bought a strangle. But the trade-off in this kind of a hedge is what? The trade-off is that you're buying this option pretty expensive from volatility terms, right? So you are paying up for this particular option. You hope to capture the risk premium in this one, but you will lose the risk premium here, right? So now that you're thinking in volatility terms, yes, this is a way to capture the volatility risk premium. This absolutely is, but you are paying up for these kinds of options, right? This option you're paying for more than what it's worth, and you are one of the people who's actually paying risk premium over here. Does that make sense? It's a trade-off. Yes, तुम्हारा बेसिकली देखो, ट्रेडिंग में कुछ फ्री नहीं आता. अगर तुमको डिफाइंड रिस्क चाहिए, तुम बोलते हो भाई मेरे को 16,000 का लॉस झेलना है, मैंने इससे ज्यादा मैं लॉस नहीं झेल सकता, जो यहाँ पे तुम्हारा मैक्सिमम लॉस है, राइट? तो उसके लिए यू आर पेइंग फॉर दिस इंश्योरेंस, बट यू आर पेइंग अ प्रीमियम, राइट? सो let me see if I've like covered everything I wanted to today. Oh, let me show you the tool we're building. हाँ, रात नींद नहीं आएगी without that. So that's funny. To be able to sleep at night, you want these hedges. Let me show you what I am doing, selling these. I'm long options as well. I'm long options everywhere actually. So yeah, you're right. It's business insurance essentially, right? It's like buying wings, buying options gives you business insurance. That's what market makers also do all the time, where um, you want to be at a stage where if something crazy happens, you don't want to lose a lot of money because you want to be playing the next day, right? No, you don't need to calculate RV, but yes, bro, like let's do, if you want, what I can do is, I'll do a session with you guys at the end maybe, where or you free, when I run the next batch of this, you guys are free to join that also. And what I'll do is I'll do a calculation of RV right in front of you guys, because we should know what RV is. We should have an idea. And it's not hard to calculate. It's a standard deviation, guys. It's like class 11th की statistics में हमने पढ़ा था ये. ठीक है, तो हमको आना चाहिए, because option trading is volatility trading. And once you actually put the numbers in Excel and change some values and see how they change, that's when you get a true feel of what the hell is actually happening. Okay, let me show you the tool. So this is in our development environment right now. This is showing me the 30-day realized volatility and the 30-day implied volatility, right? थोड़ा सा स्लो है मेरा लैपटॉप आज, वेट. So यहाँ पे what you'll see is around election is what you'll see, right? So the blue line is the realized vol, the orange type line is the implied vol. Wait, it's still in development right now. You guys will hopefully get a better idea of this tool next week. But essentially it's helping you visualize that RV, IV and RV and how they're moving with each other, right? What I do is I look at this and I look at a bunch of other tools. They're all in Excel right now, but I'm putting them all on the website where I get an idea ki bhai, is volatility cheap or expensive? And if it's cheap, I buy. If it's expensive, I sell. And this is independent of my volatility book, my volatility risk premium book. VRP is happening on its own. अब जाके चलना शुरू हुआ. Okay. So I can actually, like move this. I can increase the time. I can reduce the time over here. And it'll show you. So this little bump, this huge bump is the election. When news started coming that the BJP 400 par nahi hone wala, right? When that started happening, that's when the market started going crazy and realized volatility went through the roof, right? And then एकदम से ही IV भी देखोगे, IV spiked up till here and then एकदम से IV dropped. And realized volatility took a bit of time to drop. And this is also one of the things that you're going to actually be able to visualize, like, why did this happen? Why did RV take this long to drop? It's just a mechanical, mathematical reason for this. And वो तुम्हें तभी समझ में आएगा जब तुम actually realized volatility को Excel में calculate करने की कोशिश करोगे. ठीक है? So imagine, like, I can give you a simple explanation. कि my realized volatility is looking at my prices over a 30-day window, right? So in those 30 days at the historically, there's some days which are very volatile. Let's imagine the election day was very volatile. All of a sudden, my window is moving as my days progress. My window is moving. The day that crazy election day goes out of my window, there's going to be a large drop in realized volatility, right? And that's why you see this like huge drop over here all of a sudden. The increase is when there was that crazy move happened all of a sudden. एकदम से news आई कि Congress का India alliance might win more votes than the poll said, and then यहाँ पे आया कि चलो भाई power में अभी भी BJP है, right? So this is the day when that crazy move as a result of India potentially winning actually got out of my rolling window of prices. Does that make sense, guys? All right, guys. Yeah, I mean, this is heavy stuff, guys. This is not, देखो, like the way I think about this is, the way my seniors taught me. ठीक है ना? The way my seniors taught me was, उन्होंने एक बड़ी शानदार analogy दी थी, which was, think of this. So Om sent a message saying, I'm absorbing, right? So think of this as this course. There's a reason this course is free. And I don't want to charge 10,000, 20,000 rupees, that sort of shit. Because उसमें क्या होता है कि I think it creates a relationship आज की डेट में of like टीचर स्टूडेंट का ऐसे हो जाता है कि मतलब इट्स काइंड ऑफ लाइक अ रेस्टोरेंट. आप रेस्टोरेंट में जा रहे हो और आप बोल रहे हो मेरे को ये चाहिए, राइट? और मैं अगर आपको रेस्टोरेंट में जाके ये डिलीवर नहीं कर पाऊंगा तो मैं रेस्टोरेंट का ओनर हूँ, मैं कुक हूँ, मैं शेफ हूँ, मैं अगर नहीं डिलीवर कर पाऊंगा तो भाई मुझे पैसे वापस चाहिए, राइट? बट जो एटीट्यूड मैं चाहता हूँ आप लोगों का होना चाहिए इज नॉट दैट ऑफ यूर कमिंग टू अ रेस्टोरेंट एंड यूर ऑर्डरिंग अ मील. द एटीट्यूड दैट आई वांट फ्रॉम यू इज कि यार अगर मैं शेफ हूँ तो आप सब मतलब जूनियर शेफ्स हो मेरे साथ, राइट? एंड मैं आपको रेसिपी दे रहा हूँ कि भाई ऐसे ऐसे दुनिया चलती है, ऐसे हम खाना पकाते हैं, ऐसे ये वाली मील बनती है, राइट। एंड फिर आप सब समझते हो, सोचते हो, खुद बनाने की कोशिश करते हो, एंड देन मे बी मैं आगे चखूंगा आप सबकी मील्स, यार इसमें नमक कम है, यार इसमें तेल थोड़ा ज्यादा डालना चाहिए था, इसको थोड़ा ज्यादा कुक करना चाहिए था, राइट। सो दैट इज व्हाट आई वांट यू गाइस, इट्स नॉट इजी, दैट्स व्हाई, मतलब सी 93% of Indian retail traders have lost money by trading in the F&O segment. I can tell you that 92% of those 93 uh, were not volatility trading. They were not trading volatility. ठीक है? They were just buying options, doing this, doing that. Indicators देख रहे हैं, सारी चीजें देख रहे हैं. तो um, I know for a fact because I have traded against Jane Street. You guys have heard of Jane Street. I've traded against Jane Street in New York. Um, I know, like I used to compete with Jane Street. Like our desk used to compete with Jane Street, Susquehanna International Group, all these other banks as well. And we used to compete for the same flow, same orders, right? So we were taught in a certain way. We were taught by our seniors with the attitude of कि भाई मैं तुमको यार अगर आज कुछ समझाता हूँ तो तुम 10x, you're going to spend 10x the amount of time researching, understanding, and then asking me intelligent questions, right? And that is how you are actually going to get value out of this course. Because if you are just like यार मुझे बता दो क्या करना है और मैं कर दूंगा, तो उसके लिए तो यार मेरा प्रोडक्ट है, आ रहे हैं एल्गोस, वहाँ पे आ रहे हैं स्ट्रेटजीज डाली हैं, वो जाके चला दो, राइट। दिस कोर्स इज मोर अबाउट द व्हाई, कि व्हाई डू ऑप्शंस बिहेव अ सर्टेन वे, व्हाई डिड आई मेक मनी, व्हाई डिड आई लूज मनी इन दिस पर्टिकुलर ट्रेड, वी नीड टू अंडरस्टैंड दैट, एंड looking at options through the lens of volatility is the way to do that. So I'm the head bawarchi. Um, thanks. Yes. So I am the head chef over here. You guys are the cooks who are learning, right? And I want you to make mistakes. I want you to play around with this tool that I have, the strategy builder, the simulator. Play around with this tool. Um, Start looking at volatilities. Um, and build more intuition about IV, Next lesson, there's a homework right now. You need to know very well what delta, gamma, theta, vega means. Excuse me. Because next lesson, we're going to be talking about risk. Now we know volatility, risk premium. We know we are being paid to take on risk. But once we take risk, we need to know how to manage it. So next class is going to be about that. Okay, guys? Okay, I'm off. See you guys.